Good evening, everyone. I welcome you all to this second session on technical analysis of direct tax provisions of Budget 2024. So it is a sequel of the budget session that was kept day before yesterday by Girish Ahuja sir. Today we have esteemed faculty, expert speaker, I would say Senior Advocate Saurabh Soparkar sir. I request Purushottam Khandelwal sir, Sunil Sanghvi sir, Prakash Nandula sir, and Riken Bhai to escort our expert speaker to the dais. A big round of applause. I request all the members to rise up for the ICI motto.
Yaesha supteshu jagrati Yaesha supteshu jagrati Kamam 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 Nirmimanaha Tadeva Shukram Tad Brahma Tadeva Amritamucchate Tasmin Lokaha Shataha Sarve Taduna Yati Kaschan Etadvaita
Now I request dignitaries on the dais and off the dais to join us for the lighting of the lamp. Neerav Agrawal, Vice Chairman, Chintan Bhai Patel, Regional Council Member, Vikas Bhai, Regional Council Member to join us for the lighting of the lamp. Ajit Bhai, sir, please. All the past chairmen to be on the dais for the lighting of the lamp.
Shubham Kurutvam Kalyanam Arogyam Dhanasampadah Shatru Buddhi Vinashaya Deepajyotir Namostute Deepajyotir Namostute.
Now I request Sunil Sanghvi sir, Chairman of Ahmedabad branch, to address the gathering.
Respected today's faculty, Senior Advocate, Sri Saurabh Soparkar sir, President of the Chartered Accountant Association, Sri Riken Bhai Patel, Central Council Member, C.A. Purushottam Khandelwal, Secretary of the branch, Ahmedabad branch, C.A. Sunil Shah, Honorary Secretary of the Chartered Accountant Association, C.A. Prakash Nandola, Honorary Secretary of the CA Association, again C. Ashish Sharma, Vice Chairman of the Ahmedabad branch, C. Neerav Agrawal, Regional Council Member present over here, C. Vikas Jain, C. Chintan Bhai Patel, and all senior members present over here and friends. I welcome all of you. And good evening. First of all, very thankful and grateful to Senior Advocate C.A. Saurabh Soparkar sir for sparing his valuable time and giving his assent for taking this budget session for all the budgets. He always tries to present and deliver his seminar. Let's have a big round of applause for the sir. Thank you very much, sir. We have significant changes in the budget. With certain changes are welcome, that the long-term capital gain tax have been decreased to 12.5% for the non-financial asset. The TDS provisions, the search provisions have been rationalized. And certain things may not be liked by us, that maybe the TDS provisions, that TDS applicability have been introduced, section 19040, the new section for the partners' remuneration, partners' interest. And as I told you earlier also, that now most of the TDS returns may be revised also in the month of September, or the receipts of the buyback. Now it has been taxable from the 1st October 2024 as a deemed dividend under section 222F of the Income Tax Act. Sir is present over here. Nothing much I would like to say. And once again, thank you all of you. Thank you.
Now I request Sunil Sanghvi sir again and Purushottam Khandelwal sir, Central Council member, to felicitate our expert speaker of the day, Saurabh Soparkar sir, with a bouquet and a memento. Again, request Rikin Patel, sir, Chairman, President of Chartered Accountant Association, and also Prakash Nandola, sir, Joint Secretary of Chartered Accountant Association, to felicitate Saurabh Soparkar, sir, with a bouquet and a memento. Now I request CA Riken Patel, President of Chartered Accountant Association, to address the gathering.
Good evening, friends. Respected faculty for the day, learned Sri Saurabh Soparkar sir, Sanghvi sir, the branch chairman, Central Council member Purushottam sir, Secretary of branch Sunit, Secretary Prakash Nandola, respected past presidents of the association, the branch past chairmans, the regional council members, and my dear friends. I would not take much of the time between you and the Saurabh sir, but I would like to share my experience way before 25 years. When we were student, we used to sit on the stairs of the Tagore Hall and used to listen Saurabh sir. And as president this year, once the budget dates were announced, I started receiving calls from the members કે આપણે સૌરભભાઈનું lecture ક્યારે રાખ્યું છે. And in this July month, we have with us Saurabh sir to deliver and clear the doubts that are arising from the new provisions of the finance bill. And before I hand over the charge, I would like to make two announcements. On the 2nd August, we, along with the Ahmedabad branch, have jointly organized one visit to Akshay Patra Foundation. They are serving midday meal to lakhs of children from their central kitchen at Ahmedabad, which is one of the mega kitchens. It's worth visiting place. I would request the members to join for it. And no registration fees is there. We have to just register on the link. And we have arranged a meeting, a visit of the kitchen, and their Prabhuji will address us, and the delegates from the kitchen will explain us the entire process. And on 9th, we have a cultural program. The tickets are available at this venue. After this session, we can have it. With this, I thank you all. Over to you, Sunit.
Thank you, Rikin bhai. I thank you, Purushottam Khandelwal sir, to be present here. Also, thank you, Chartered Accountant Association, for joining us in this event with ICI Ahmedabad. Not taking much of the time, everyone knows Saurabh Soparkar sir. He is a senior advocate practicing with CIT appeals, tribunals, and the high courts in the income tax. Sir, the dais is all yours.
And the president of the association. If at this stage I need to be introduced to this gathering, then I have miserably failed in my duty of being with you for more than now 3 decades. Let me start the overall view of the finance bill. This has been an interesting year politically. Nobody would have thought 2 months back that BJP would not get power on its own, or that it would require support of two other political parties to be in majority at the central government level. In view of this changed equation, maybe there was a feeling that we will have a different kind of finance bill. However, we find that this year's finance bill is little tricky. The reason being, if you have an overall view of the finance bill, you will realize that department over a period of time is becoming more and more system driven. TDS, the filing of forms, statements, annual returns, more and more provisions are being introduced for the purpose of ensuring that there is a compliance of those provisions which are in a way fringe provisions. The reason is that revenue is now trying to catch people who apparently are not correctly disclosing income by gathering data. And that's the reason why instead of having amendments on, as we might say, main issues under the Income Tax Act, we find many, many procedural amendments creating more and more obligations on the part of the SSC and therefore on your part of complying with and more statutory requirements of filing forms, etc. Which results into a situation where this year's finance bill runs into 99 amendments, and with the close typing or close printing, it runs into 83 pages. I have not seen such a lengthy finance bill in recent past. The reason for this length is that a large number of amendments are of the nature which are minor and or sometimes major procedural issues. If I were to discuss each of them, we might have to, or I'll have to request them to arrange for tomorrow morning's breakfast, because dinner in any case would be there. But I have no desire. Therefore, what I propose to do is, as I usually do every year, I would be discussing around 18 to 20 major issues which I believe are worth being considered over here, and maybe 8 or 10 minor issues. Rest are all of small procedural issues or which do not affect the large number of members present over here, taxation of the vessels which are plying, or some taxation of foreign companies, etc. With this, let me again have one more preliminary remark. We have all these amendments, some of which we will see, but two issues are conspicuous by their absence. Everybody expected some relief or some provision in relation to this, and they are therefore conspicuous by their absence. One, there has been a significant debate on Section 43, capital B, small f, MSMEs. All of us are aware that on account of amendment brought in last year, an amendment which was supposed to be for the benefit of MSMEs has, so to say, boomeranged, and MSMEs are now facing problem because people are reluctant in dealing with MSMEs because they are not sure as to whether outstanding amount beyond a period of 40 days would be allowed as a deduction. And therefore, there was a hue and cry about an amendment being brought in which would, so to say, make people comfortable while dealing with MSMEs. That amendment has not come. Similarly, people expected extension of the concessional rate of tax under Section 115 BAB if you are starting a new manufacturing unit. The last date was 31st March 24. That has not been extended. people had almost taken it for granted, it would be extended. And therefore, those who are in the pipeline hoping that extension would come, they would be unable to take the benefit of lower rate of tax. So these are two amendments which are conspicuous by their absence. There is no such amendment as one would have expected it to be. With this, let me now go to the provisions which are proposed to be amended. In as much as I go section-wise, I would be taking issues one after another as they come. The first proposed amendment is in the matter of buyback. Why does it come first? Because definition of dividend is sought to be amended. We had so far section 2, clause 22, subclauses A, B, C, D, E. Now it is proposed to add clause F. Let's go to the provision of buyback as it stands today. Say I have invested into a company's shares by putting in rupees 1 lakh, let's say 5 years back. And company now seeks to buy back my share by giving me rupees 3 lakh. So against my investment of rupees 1 lakh, I am getting rupees 3 lakh. By virtue of provision of section 1034A, the gain in my hand was totally exempt. However, by virtue of provision of section 115QA, the difference between the price at which company would buy the shares, rupees 3 lakh, and the amount originally received by the company, namely rupees 1 lakh, difference being rupees 2 lakh, was subjected to tax as buyback tax under section 20, at 20%. Which would mean the transaction was exempt in the hand of shareholder, whereas in the hand of company, it had to suffer buyback tax of 20%. Now it's a fact that by many companies, instead of distributing dividend, resorted to buybacks on a periodical basis. If they would distribute dividend, the shareholder would have to pay tax at the regular rate, which could be as high as 33%. Whereas by resorting to buyback, the company would pay tax at 20% plus surcharge, and then money can flow from the company to the shareholder. The revenue wanted to stop this. But then what is the proposal? And that is where the whole problem comes up. The proposal is the amount that a shareholder would receive on buyback, in the example that I took, rupees 3 lakh, would be treated as dividend in his hands. Number one. Now he has paid rupees 1 lakh, he is getting rupees 3 lakh. The second amendment is rupees 1 lakh that he has paid would also not be allowed as a deduction against dividend income. Section 57 is also sought to be amended. Then how do you treat rupees 1 lakh? Section 46, capital A is sought to be amended, whereby amount of cost of dividend in the hand of amount of cost of original shareholding in the hand of shareholder, namely rupees 1 lakh, would be allowed to him as a capital loss. So, in the hand of the shareholder, whereas so far he was getting rupees 3 lakh without any tax, and company was paying tax on rupees 2 lakh differential, now shareholder will have to pay tax at the regular rate as dividend on rupees 3 lakh, and he will be told that amount of rupees 1 lakh, which is the cost of your share, would be allowed to you as a capital loss. Now, if the share is held by him for more than 2 years, it will be a long-term capital loss. In any case, all of us are aware, capital loss can be set off only against capital gain, which would mean, now take a little extreme example. I have paid rupees 5 lakh to acquire shares 2 years back. Let's say 3 years back. This year company is buying back the shares by giving me same amount of rupees 5 lakh. So I gave rupees 5 lakh, I got back rupees 5 lakh. Now when I get back rupees 5 lakh, it is dividend income. and rupees 5 lakh that I have invested is a capital loss. Effectively, therefore, what you are doing is you are creating dividend income even by attributing your investment cost as a dividend. Your investment cost is not being allowed to you as a capital loss. It is allowed to you as a set off against dividend income. That itself is a capital loss. I can understand the amendment to make it equivalent to dividend. Then what you ought to have provided is rupees 3 lakh that you receive is a dividend income, and the cost of investment into share, rupees 1 lakh, be allowed to be set off under section 57. Then it is in a way equitable, right or wrong, but I can understand that argument that rupees 2 lakh that you have received in excess is your income, treat it as dividend income. But how do you say that I have received excess of rupees 3 lakh? I have received excess of only rupees 2 lakh. By treating my investment also as a part of excess and saying that your investment is a capital loss, are you not creating a situation whereby people are compelled to take up a position that investment is gone and now whatever I receive is my income? To my mind, this is a provision which is seriously impacting all buybacks. The buyback provision is to come into effect from 1st October 24, new amendment. Now, beauty of this finance bill is some provisions are from October, some provisions are from September, some provisions are from January, some provisions are from last April, some provisions are from next April. It's reasonably confusing. To some extent, I will be dealing with wherever I believe is material. This provision is going to come into effect from 1st October 24. There, if you can finish buyback before 1st October 24, you will be governed by the old law. Otherwise, you will be governed by the new law. A question was raised, is this provision constitutionally valid? To my mind, it's possible to argue that to the extent I am told that against dividend income, even the cost of investment will not be allowed to me as a deduction, may not be a valid provision of law. You cannot say that my investment itself is a dead loss and dividend income is to be taxed. There is another issue which is going to again be a problematic issue. Some of you will recall, originally when section 115QA was introduced, the language of the section was buyback under section 68 of the Companies Act. So it was clear that the buyback exemption would be applicable only in relation to the buybacks which are effected under section 68 of the Companies Act. Now, I can do buyback ordinarily under section 68 of the Act. But it is also possible for me to do buyback by virtue of a scheme of compromise or arrangement under section 230, 231 of the Companies Act. And therefore, arguments were being raised that this buyback provision would not apply to the schemes which are floated not under section 68, but under section 230, 231, 232 of the Companies Act. Section 68 is a simpler procedure where only by passing a resolution in the general meeting you do buyback, whereas section 230 to 232 is a scheme which you need to get it sanctioned from NCLT. Now, whereas section 115QA therefore was amended to cover not only buybacks under section 68, all kinds of buyback, the new avatar whereby section 222F is introduced, it only deals with buybacks under section 68, which would mean that if you do buyback not under section 68, but under general provision of the Companies Act, maybe it may still be open to you to argue that this provision would not apply. Go by the general principles of law. Against rupees 1 lakh of my investment, I have got rupees 3 lakh. Therefore, it's a capital gain, and I must be called upon to pay tax on the differential amount of rupees 2 lakh. Therefore, this is still a window open. I am not sure how far that window would remain open in the sense, so the moment it is realized that this particular window is open, maybe government will step in and try to plug it. But today, that particular window is still open. That takes me to the second major amendment in relation to the capital gains. Section 242A, holding period. All of us are aware that today we have got two kinds of capital gains, short-term capital gain and long-term capital gain, depending upon whether your asset is a short-term capital asset or a long-term capital asset. Whether asset is short-term or long-term depends upon your holding period. Now, in the matter of holding period today, ordinarily if you hold an asset for 36 months or more, it becomes long-term. However, in relation to two kinds of assets, namely shares of a company, which is an unlisted shares, and immovable property, that 36 months period is scaled down to 24 months. Further, in case of shares of listed securities, shares and securities that are listed on the floor of stock exchange, that period is further scaled down to 12 months. Today, therefore, we have three different parameters. Listed securities 12 months, unlisted securities and immovable property 24 months, and rest of the assets 36 months. Now, the proposal is we will scale down that 36 months to 24 months for everyone. So, 36 months goes down to 24 months. Therefore, if you have a gain, you would be exposed to pay tax at a lower rate. If you have a loss, it becomes a loss which can be set off only against long-term capital gain. However, in case of listed securities, that period of 12 months is still retained. So, unlisted securities, unlisted shares, where holding period was 24 months, still 24 months. Immovable property, 24 months, it still continues to be 24 months. But all rest of the assets, gold, jewelry, ornaments, intellectual properties, everything else which had to have 36 months holding period, now the holding period goes down to 24 months. Correspondingly, there is a change in the rate of taxation. Now, if you ask me the different rates at which different kinds of assets are subjected to capital gains tax, it is almost impossible to say off the cuff, because now there are so many alternates. But let me very briefly indicate. Under the old scheme, if you have a short-term capital asset, it was to be taxed at 15% if it is a listed share, units of equity-oriented mutual fund, or units of certain business trust. So for them, it was a lower rate of 15%. For rest of the short-term capital gain, it was 30%. That 15% is now being scaled up to 20%. So short-term capital gain not to be taxed at 15%, but to be taxed at 20%. Long-term capital assets or long-term capital gain, now there are again two parts. If it's a listed security or units, please recall, hitherto it was being taxed at 10%, now it is to be taxed at 12.5%. So in case of a long-term capital asset, in the form of listed security, instead of 10%, you would be required to pay tax at 12.5% on the gain. So far as regular long-term capital gain is concerned, hitherto it was 20%, it is now being brought down to 12.5%, which would mean that so far as the financial assets in the form of listed assets are concerned, listed securities are concerned, that the enhancement of rate at 2.5%. For rest of the assets, there is a reduction in the rate by 7.5%. Further, if you are having capital gain, which is security tax paid, today there is an exemption up to rupees 1 lakh, which is being scaled up to rupees 1.25 lakh. But then there is one more facet, which is the one which has been raising all sorts of controversies, namely removal of indexation. Now, all of us are aware that whenever you sell a long-term capital asset, depending upon from when have you been holding the asset till the date you sell the asset or you transfer the asset, depending upon the length of your holding, you were entitled to get indexation. Why were you given indexation? It was not some kind of a benefit or some kind of concession. It was an acknowledgement of the fact that over a period of time, value of rupee is falling down because of inflation. What was costing rupees 100 10 years back would be now costing maybe around 150. So if you have paid rupees 10 lakh to buy a property in the year, let's say 2001, today such a property would not be available for rupees 10 lakh, it would be available for 15, 20, 25 lakh. And that's the reason why, because you need to tax a citizen on his income. Income means income in the real sense, and therefore increase in the revenue or increase in consideration insofar as it is attributed to inflation is not his income. On that basis, the concept of indexation was introduced. Now the government says, we don't want to give you benefit of indexation. And when I was trying to find out why they do not want to give it, I found the reason very interesting. It is for ease of computation. So if somebody tells me that, why are you carrying, not that I am carrying, but why are you carrying so much of currency notes in your pocket? Let me take out some currency notes from your pocket. It will be easy for you. Would I ever agree? Is it for ease of computation that you are saying that indexation is being removed? But in the name of ease of computation, anything and everything will go ahead. So now there is no indexation. But they are also seeking to justify that with the reduction in the rate of tax applicable to long-term capital gain from 20% to 12.5%, SSs will not lose. So I was trying to figure out what is the real situation. So I go by a situation where an asset is acquired, immovable property, before 1st April 2001, because otherwise indexation will go on changing from year to year. If I acquired property prior to 1st April 2001, as you are aware, I am entitled to take the market rate being the circle rate or jantri rate as on 1st April 2001 as its cost. Let's say my original cost was rupees 10 lakh. The market rate or jantri rate was rupees 20 lakh. This year indexation factor is 363. So which would mean that I am entitled to increase that cost of rupees 20 lakh by 3.63 times, so roughly around 60-70 lakh. Question is, if I sell this property this year, do I stand to benefit with the withdrawal of indexation and reduction in the rate of tax? Or do I stand to lose because of withdrawal of indexation? Now, one thing is certain. Let's say I have bought a property in 2001, but the prices have not gone up significantly. My property worth rupees 1 crore then is today worth rupees 3 crore. Under the old scheme, I have suffered a loss of rupees 63 lakh. But under the new scheme, I have made a gain of rupees 2 crore. So under the old scheme, I was not required to pay any tax. Now I am required to pay tax of rupees 25 lakh at 12.5% on the gain of rupees 2 crore. So when do you reach a situation where the old scheme versus new scheme, there is some kind of set off and new scheme starts becoming more profitable? I did some rough calculation, and what I find is, as compared to your value, as on 1st April 2001, if the market value today has gone up by 9 times or more, the new scheme benefits you. Because under the old scheme, you will get indexation, but then at the end of indexation, you end up paying tax at 20%. But if value has gone up, market value has gone up by more than 9 times, even though you lose indexation, because the rate of tax, even though it is applied from the gain of rupee 1, still because of reduction in the rate of tax, you start making a gain. Therefore, those who have, let's say, pieces of land in the periphery of Ahmedabad, the Jantri value on 1st April 2001 was almost non-existent, or it was token. And today the properties are worth crores of rupees. All of them would be significantly benefited by the new scheme. But those who have got, let's say, flats in the city or houses in the city where appreciation is not significant, they'll end up losing because of this. I also cross-check by taking the value of gold. The market value of gold as on 1st April 2001 was rupees 4,000 for 10 gram. And today, it's around rupees 70,000 per 10 gram. Under old scheme, that 4,000 would become, after indexation, 14,520 at 3.63 times. Therefore, gain would be rupees 55,480, and the tax payable would be rupees 11,096. Under the new scheme, I need to pay tax on the difference between 70 and 4,000, 66,000 at 12.5%. It comes to rupees 8,250. So in case of gold, which has appreciated almost 16, 17 times, the new scheme is beneficial. So I would not really run down the new scheme by saying, oh, everybody is to lose. Nor would I say everybody is to benefit. This is according to one's own calculations, and depending upon how you are placed, whether or not the new scheme is likely to benefit or not would have to be decided. Yesterday, the Finance Ministry has given some clarification, but that clarification is more confusing than clarifying. What they have said is, there is a rollover benefit and option. So I was wondering whether rollover benefit or option is given to me, whether do I go by old scheme, indexation and 20%, or do I go by new scheme, no indexation and 12.5%. But from what I could read from that small X or that particular website, apparently the option is, if you are holding property prior to 2001, April 2001, you have option of taking cost or market value 1st April 2001. This is the option. But that the law in any case gives me. What is new about it? This is explained by Honorable Finance Minister on Twitter that, look, this is the clarification. Rollover option is still available to you. But that option is not being given to me under the amendment. That option in any case is available to me. So this clarification, frankly, is no clarification. I now go to the third issue, which is number of small amendments. Therefore, I will take up under one head, merger of the two independent system of charitable trust taxation. Today, we have got section 1023C, under which inter alia educational institution, universities, etc. would be entitled to take benefit. We also have the scheme under sections 11 to 13. At a time when these sections were introduced originally, they had different purpose to serve. Section 1023 was more rigorous, but the benefit was also significantly more. Total income was exempt. There was no need to use up the money within 5 years. 11.5 prohibitions, etc. were originally not there. Over a period of time, for one or another reason, the government has always looked at the whole wing of charitable trust with an eye of suspicion. And therefore, you find every year these provisions are so mutilated, it's impossible to make sense of many of them. 1023C has, I believe, about 17 or 18 provisos. Now, how do you, by the time you reach the 5th proviso, you have forgotten the 4th proviso. You have to reach 17th or 18th proviso to understand the whole scheme. Be that as it may. Now what is proposed is, they want to merge the two and take everyone to section 11 to 13. So section 1023C would be, over a period of time, be made non-operational. So how do you make it non-operational? It is not by a stroke of pen. What they say is, no new application for registration under section 1023C would be accepted after 1st October 24. Second, applications which are pending on that day would be processed for 1023C. But all trust funds or institutions which are today registered under 1023C will continue to get benefit till validity of their approval. So if there is an institution of which validity expires on March 25, he will get it up to March 25. Somebody is up to March 26, it will be March 26, March 27, March 27. So you still have a validity benefit till the validity is given to you. But at least 6 months before your validity is coming to an end, you must apply for registration under section 12A1AC clause 2. In other words, you must migrate from 1023C to section 11 before your recognition comes to an end, and unless you make an application to migrate, if you do not make the application to migrate, then you will not be given any extension under 1023C. In other words, after 1st October 24, there will be no renewals of exemption under 1023C. Now, as I said, 1023C is little wider and it has little more relaxed matter of investment, whereas section 13 has little more prohibitions. So then section 13 is being slightly relaxed so as to be in line with section 1023C requirement, so that those who move from 1023C to section 11 to 13 do not attract disqualification of section 13, so long as they do not attract disqualification under the first scheme. Power is now given to commissioner, and this is an independent provision, which is a good provision. Power is now being given to commissioner to receive application for registration belatedly, so under section 12A1AC6, provided the SS is able to show reasonable cause in not making application in time. So if you are able to show good cause for the delay is likely to be condoned, and if he doesn't condone, obviously you can challenge it before the High Court. Now they also look at merger of two charitable institutions. Now we have chapter 12B, sections 115 TD to 115 TF, which are in a way draconian provision. If a charitable institution ceases to be a charitable institution, then all assets accreted, all assets earned by the charitable institution would be taxed at the maximum rate. But now what they are proposing is, if a charitable institution gets merged into another charitable institution, then it will be permissible to do so, provided there are 3 conditions. Nothing comes under the Income Tax Act without conditions. So the 3 conditions. 1, that the other charitable trust, let's say A goes into B, then B should have same or similar object. Problem number 1. Same or similar object, meaning thereby a hospital trust cannot merge into a school trust. Now, so long as the trust is prepared to carry on all activities, why should government have any objection? But no, it should have same or similar object. Second issue, whether all objects must be same or similar, in the sense, the first one has, let's say, hospital and only medical objects. The second one has, to begin with, objects of education as also hospital or medical. Same or similar would mean identical at both ends or similarity at both ends. These are issues which are likely to come up at future. Then the other institution must be approved under section 12AA or 12AB, that's fine. And that merger satisfies such other condition as may be prescribed. Now this is the problem. As may be prescribed means they will prescribe it by rules, and therefore in all probability they will prescribe conditions which are almost impossible to meet with. Now why should there be an objection on principle to merger of 2 charitable institutions is a question which baffles me. But nonetheless, now there is a possibility of merger of two institutions provided you satisfy these three conditions. That takes me to the next major amendment to section 40 clause B. It's not major, but it is important because it applies to or affects large number of SSCs. In good old days, firm was treated as to be taxed at a lower rate, and interest and salary paid to partner was not to be allowed, but then law was amended. Now firm is to be treated as a separate entity, and you tax the firm, share of profit is not taxable, but then you allow remuneration, salary, commission, bonus, whatever you call, generic name remuneration, and interest to partners to be allowed only in certain situations. Now we are not dealing with interest, there is no amendment there insofar as 40 clause B is concerned. In relation to remuneration, way back in the year 2010-11, the ceiling was prescribed, which was if your book profit is up to rupees 3 lakh, then rupees 1,50,000 or 90% of book profit, whichever is higher, was to be allowed. So if your book profit was, let's say, rupees 2,50,000, you could get 90% of 2,50,000, 2,25,000, or 1,50,000, whichever is higher. So 2,25,000, and for the amount in excess of rupees 3 lakh, it was at 60%. Now, government recognizes inflation here, not for the purpose of indexation, but it recognizes here 3 lakh becomes 6 lakh, and 1.5 lakh becomes 3 lakh. So if your book profit up to rupees 6 lakh, or for the first book profit of rupees 6 lakh, you are entitled to pay remuneration to working partner, no change there, remuneration to working partner to the extent of 90%, or rupees 3 lakh, whichever is higher, and for an amount of book profit in excess of rupees 6 lakh, you are entitled to pay remuneration to the extent of 60% of your profit, again to a working partner. We'll go to TDS provision a little later. The next amendment is section 47 Roman 3, and this, which is to my mind little unusual. Under section 47, certain transactions are prescribed which are not to be taken as a transfer. And because they are not to be taken as a transfer, on the happening of that event under section 47, no capital gain tax is payable. One of the items that is prescribed is under section 47 Roman 3, that if you give a gift, then that transaction is not exigible to capital gains tax. Correspondingly, under section 49, the provision is in the hand of the donee recipient, the cost remains the cost in the hand of the donor. So it is not as if the transaction is exempt for all times to come, as in when donee would send, he would be required to pay tax as if the cost is not zero, cost of the donor. There is also now a prohibition under section, not prohibition, taxation under section 56 to 10, where all gifts are in any case subject to gifts within relatives. In any case, gifts are taxable. So nobody would really give a gift except to relatives. Now, the government says, or the finance minister says, gift will have to be only out of love and affection. And you can have love and affection only if you are a real person. So section 47 Roman 3 will apply only if you are an individual or HUF, which would mean all transactions of gift or all transactions of transfer without consideration, let us take a hypothetical case, by a firm would be taxable or would not be exempt under section 45. So let's now analyze this. A firm transfers, let us say the firm has gold worth rupees 20 lakh. It chooses to give a gift of gold worth rupees 20 lakh to Mr. A. Now 47(3) will not save it. But how do you tax him? For the purpose of taxation of capital gain, law is very clear, you need two things, consideration and cost of acquisition. There is a cost of acquisition because gold, as and when it was acquired, would have a cost. But what is the consideration? If you take zero, I would be entitled to claim capital loss. Now, there are provisions under the Act where even if you have taken no consideration, the law will presume that certain amount would be deemed to be consideration. For example, under section 50C, if I transfer a piece of land or immovable property at a price below the market rate, including at 0 rupees, then the circle rate or jantri rate is my deemed consideration. Therefore, I would have to pay tax. 47(2), 47(3) may apply. 50CA, transfer of shares of unlisted company. Again, if I am transferring or gifting shares of unlisted company from a partnership firm to a third party, 47(3), read with section 50CA, the firm may have to pay capital gains tax on the notional value of the asset transferred. But keep apart those two exceptions. In rest of the assets, let's say partnership firm transfers, as I said, gold, some paintings, intellectual property rights. How do you tax it? There is no machinery by which the taxation will take place. It is equally true that a firm transfers the property without any consideration to anyone, let's say third party. In the hands of the recipient, 56(2)(10), in any case is required to be considered. That in any case, even today you are required to consider. Therefore, for gold, paintings, shares, 56(2)(10) will apply. But then the definition of property under 56(2)(10) does not capture every property. For example, intellectual property rights are not captured there. Therefore, suppose there is a firm which has a huge brand, and because there is a restructuring of the firm chooses to gift away the brand or hand over the brand to one of the partners or a third party. If it's partner, 45(4) may apply. So let's assume there is no 45(4), no partner. Let's say third party. Without consideration, how would you tax it? There is no deeming fiction by which firm will be taxed. The machinery of taxation would fail. Srinivas Shetty would apply. In the hands of the recipient, 56(2)(10) would not apply. Therefore, the very premise of removing exemption under section 47(3), that by removing we will bring everything under the fold of taxation, is fallacious. I must, however, discuss one provision. There is a provision of section 50(D), which prescribes that if there is if on a transfer consideration is not ascertainable or cannot be determined, market value would be the deemed consideration. I don't believe 50D can be invoked in this case because it is not as if consideration is not ascertainable. It is nil consideration. It is ascertainable, but it is nil. Or cannot be determined. It can be determined, it is 0. So to my mind, even 50D would not apply and the transaction would fail. That takes me to one anomaly, section 55, which again, and this is the only provision brought in retrospectively. And a little factual aspect. All of us see in the newspapers every day, not every day, from time to time, IPOs being made. IPOs are the initial public offering of by shareholders of a company, sometimes by the company, but in most of the cases by the shareholders of the company, in order to offer the shares in the market and thereby get the listing. Now, irony was that if the shares are sold at IPO, they would bear security transaction tax because of the requirement of STT laws. But the shares would be sold before listing because once they are sold, thereafter there are large number of shareholders and then the listing will take place. So at the time when the shares are sold, it was in a way hybrid instrument. It was STT paid instrument, but which was not a listed instrument. If you look at the cost of holding, cost of acquisition as defined under section 55, it defined cost of all instruments which are STT paid and listed, or neither STT paid and nor listed. This was an instrument which was STT paid but not listed. And therefore, it was possible to take a position and I am aware that quite a few industrial houses did take up a position that this transaction is not exigible to tax because cost of acquisition cannot be determined. Section 55 fails. Honorable Finance Minister acknowledges that position, that for want of cost of acquisition, the levy would fail. Going back a little, then why do you introduce 47.3? On the same principle, for want of consideration, levy would fail. But I'm sure those who have drafted 47.3 did not apply mine to 55 or vice versa. Now, going back to 55, the Honorable Finance Minister acknowledges the fact that in view of the fact that cost of acquisition is not determinable by virtue of Srinivas Shetty, the levy may fail. So, effective from assessment year 2018-19, law is being amended, whereby such transactions would also be subjected to tax. I am not having sympathy for those who try to claim this benefit, but the fact of the matter is this is against the avowed policy of this government that they will not bring in any retrospective amendment. But they did bring in, and therefore to that extent, people are likely to be impacted. One very positive amendment, and we must acknowledge this, is removal of or making section 56 to 7B ineffective. All of us are aware of Kolkata company Menas. It started with Kolkata, but then everybody, including Gujarat and Maharashtra, were not lagging behind to have companies with huge share capital, and then persons who have put in share capital would transfer the shares at nominal price to, so to say, second set of shareholders. Second set of shareholders would get the company with huge premium, therefore huge cash, by paying token sum of money, and the person who has sold the share either has disappeared or is claiming loss. Therefore, section 56 to 7B was introduced, that if in case of a company which is not listed on the floor of stock exchange, if the company has received any premium which is not justifiable by virtue of Rule 11 UA computation, then the differential amount is to be taken as income. Last year, initially when the section was brought in, it was only in relation to investments made by residents. Last year, they introduced even the non-residents investment, saying that from wherever you get the money, if you put in money in a non-listed company and at a premium which cannot be justified, the difference becomes income. This rate a sudden U-turn. The whole section is removed. Now, you can bring in premium of rupees 10, 100, 1,000, whatever, and 56 to 7B would not apply. Now, that is not to say, therefore, please don't go by what I said, that it is not likely to be questioned. Section 68 still applies. And therefore, if the company is not able to explain the source, genuineness, capacity, then in any case additional will take place. But ipso facto addition under section 56 to 7B will now not be made because that section itself is made ineffective from 1st April 2024. Section 139 is sought to be amended in the sense, if I am unable to file my return of income in time, I might approach CBDT seeking extension of time, and in the given case, CBDT may permit me to file return of income belatedly. So how would you treat this income, and within what time it will be assessed? So 139(9)(a) is being introduced, that any return furnished pursuant to the direction of CBDT under 119(2)(b) shall be treated as return under section 139, and correspondingly section 153 is sought to be amended by introducing subsection 1 capital B. It will be assessed within 12 months from the end of the year in which the return of income is filed. Now, two major areas, one reopening and second block assessment. Let me start with reopening first. We had for years together the concept of reopening, where we were tuned to the fact that reopening up to 4 years can be done without any, almost without there being any prohibition if it's 143(1). Assessment beyond 4 years but up to 6 years is permissible only if there's a failure on the part of to assess to disclose truly and fully all material facts. Even within 4 years, Calvinator Supreme Court had taken a view, you can't review, so on and so forth. All this old scheme was given a go-by on 1st April 21, whereby you had the concept of section 148, 148A, correspondingly 149 and 151. Under the new scheme, what was provided was, before the case will be reopened, there may be some inquiry, section 148, capital A, small a. AO will give to the SSC the inquiry report along with his reason to believe as to why income has escaped assessment. Under clause B, SSC will give response. Under clause C, AO will consider the response. Under clause D, 148AD, if AO is of the view that this is a fit case for reopening assessment, he would then issue notice under section 148 after passing order under section 148A, small d. There was also a scheme under which, there was also situations where AO can or cannot do it. We'll go to that in a moment. The scheme under the old scheme, or this scheme also said case can be reopened up to 3 years almost without there being any restriction, but from 3rd year to 10th year only in certain situations. This scheme, which is introduced in 21, has hardly lived for 3.5 years. And now that scheme is being substituted by another scheme, which is almost the same. Now, I'm not sure, as we are trying to take a small change here or there, why do you substitute the whole scheme? But then, this is what they are trying to do. Now they are trying to have the new scheme. Maybe one reason is introduction of block system. We'll go to that little later. But now under the new scheme, okay, let's look at old scheme and new scheme now side by side. Under the old scheme, notice for filing return of income was issued under section 148, where AO can say you file return of income in a period not more than 3 months, but SSC had a right to seek extension and AO had a right to grant extension. Under the new scheme, under section 148, AO will issue notice under section 148, call upon SSC to file return of income within a period not exceeding 3 months. SSC has no right to seek extension. AO has no right to grant extension. Problem number 1. AO says, maybe most irrationally, file your return of income within 3 days. And I don't file return of income within 3 days. I can't even ask for extension. And even if I ask for extension, they will say, I have no right to give extension. Or, as is usually the situation, because the phrase not exceeding 3 months is there right from 21, even now we find ordinarily it is some officers or some offices give 14 days time, some offices give 90 days time. Whatever the time is given, I have no right to seek extension. What happens if I do not file return of income within the time prescribed in the notice? Notice says, let's say 30 days or 60 days, or I take 90 days, but I cannot file within 90 days. I cannot seek extension. Therefore, I file on 91st day. That return is not a valid return. It will be ignored. So, the moment you receive the notice, you must first look at within what period you have to file return of income, and you must file the return of income. Because if you do not file return of income within time, you do not have opportunity to file return of income belatedly. Now, under the old means the present scheme of section 148, there are 2 situations where the case can be reopened. One, in both cases, it can be reopened only when the assessing officer has knowledge that income chargeable to tax has escaped assessment. So, question is, when does he have knowledge that income has escaped assessment? We have two explanations today, explanation 1 and explanation 2. Explanation 1 takes care of 5 situations today. All 5 are repeated. Namely, even under the new scheme, those 5 explanations, 5 clauses or 5 situations are repeated. Risk management strategy of the board, audit objection, information received under section 90 or 90A, that is from foreign sources. The information made available to the assessing officer under a scheme under section 135A, interdepartmental information, or information which requires action to be taken pursuant to the order of a court or a tribunal. These are 5 situations. Now the 6th is added. The 6th which is added is if there is a survey under section 133A after 1st September 24 other than TDS survey. So in these 6 situations, AO has reason to believe that income chargeable to tax has escaped assessment. But then presently we have explanation 2. Under explanation 2, by deeming fiction, it is assumed that AO has the knowledge that income chargeable to tax has escaped assessment. That deemed knowledge is in 4 situations. Search or requisition, 132 or 132A in the case of SSE. Survey under section 133A other than TDS survey. Third party search where money, bullion, jewelry, valuable article or thing of the SSE are found. Or third party search where books of account or documents of the SSE are found. This deemed knowledge, you would have marked second one, survey is already taken in the first part. The other 3 parts, the deemed knowledge is taken away. The whole concept is taken away. The reason being, now in case of search, there will be a block assessment. That is again a matter of major controversies. We'll go there in a moment. But now there will be reopening only if what we discussed, the 6 possible situation, one of the situation emerges. Like old scheme under section 148A, here also now notice will have to be issued. After notice is issued, the SSA will be heard. Thereafter, assessing officer will pass the order. If he finds that income chargeable to tax is a escaped assessment, 148AD order, and he will issue notice under section 148. Now comes a major change. Today, case can be reopened for a period up to 3 years. So 148 notice can be issued anytime within a period of 3 years from the expiry of the assessment year. Or if 3 situations, if an assessing officer has in his possession information that there are books of account, documents or evidence which kindly mark the word reveal. I'll come back to reveal in a moment. Reveal, there is an asset, expenditure in respect of a transaction or in relation to event or occasion, or entry or entries in books of account which has resulted into escapement of income in excess of rupees 50 lakh. In other words, revenue today has a right to go beyond 3 years if books of account, documents or records reveal that asset, expenditure, transaction, entry, they all would show individually or collectively income escaping tax in excess of rupees 50 lakh. Now the proposal is we come down from 10 years to 5 years. Very good. But when you go to block assessment, it is for 6 years. Now you could have kept 6 years. So regular assessment 3 years or 5 years, block assessment 6 years. So every time you have to find out whether it's a block or different. Anyway, 5 years. 5 years, but then we have now a concept of section 148 capital A, determination of escapement of income on a tentative basis before issuance of notice under section 148. 148 capital A notice, so now under 148A1 notice, so on and so forth. So now we have got 2 separate periods. Reopening within 3 years by issuing notice under 148A within 3 years, followed by a notice under section 148 within 3 years and 3 months. So 3 months period is given to pass order under section 148(3) equivalent to 148 capital A small d, so that notice under section 148 can now be issued. So 3 years and 3 months. Similarly, for the extended period where rupees 50 lakh is involved, it is 5 years for 148 capital A notice, inquiry to be finished within 3 months, final notice under section 148 at the end of within 5 years and 3 months. So now 148 can be issued either within 3 years and 3 months or within 5 years and 3 months. I said something about reveal. It was possible to develop an argument. So far, I don't believe any court has really answered this. But then it was possible, and in fact, in some of the matters, we were thinking of raising that argument that books of account record or material must reveal. Reveal must necessarily mean something which is hidden, which is now revealed. So something which is apparent on the books of account cannot lead you to a benefit of extended period of limitation, because it is not something which is revealed, it is known to you, or it should be known to you. So now, under the amended provision, what they are trying to do is the word reveal is substituted by the word show. Reveal probably is an active or a positive step. Show is relatively probably a negative or a passive step. So he can say, if record shows that income chargeable to tax in excess of rupees 50 lakh has escaped assessment, I can go for the extended period of limitation. So this is one change. Overall, therefore, the period has gone down, which is a matter of great benefit. There has been a matter of debate as to which is the specified authority under the old law versus new law that is pending in the Supreme Court. Supreme Court would adjudicate very soon. Now they are making life simple for everyone. Irrespective of whether it is to be done within 3 years or within 5 years, the specified authority is additional CIT, additional DIT, JCIT or JDIT, period. So now there is no need to go to depending upon whether it is within 3 years, one set, beyond 3 years, another set. So this is, as I said, some fundamental changes in the scheme of block assessment. This requires a little more closer discussion, but we would be running out of time, so I'm not going there. But maybe one day one will have to examine very closely as to what are the ramifications of the new scheme. I now go to the block assessment. Those of you who are in practice for quite some time would know that the government always grappled with the problem of how to tax unaccounted money, which is found at the time of search. After a lot of thinking, they came up with the concept of block assessment. Section 158B, Chapter 14B was introduced, effective from 1st July 95. That continued up to 31st of May 2003, meaning thereby for about 8 years and few months. And then for 1st June 2003, block was dropped and in place 153A, 153C were introduced. That continued up to 31st March 21. Again, that was dropped and everybody went back to the regular assessment. Now government is bringing back block. Interestingly, 158B becomes new 158B, 158BF becomes new 158BF, 158BFA becomes new 158BFA. They are not even changing the nomenclature of the section. There is a significant change in the contents of the section. But if you go by the heading, you are likely to be misled because they have kept the same heading of every section. The definition of block period is the same, 6 years plus the broken year of search. Therefore, let's say, because it is effective from 1st September 24, I take an example of search on, let us say 21st October 24. So then in that case, if I 1920 to 24-25, last 6 years, and period from 1st April 24 to 20th of October 24 would be the block period. Thus far, no problem. Then comes the issue of how do you compute the unaccounted income. And this is where you would find they have tried to amalgamate block with 153A, and in the process of amalgamation of block and 153A, quite a few complications are going to arise. So let's go each one. There is a definition of undisclosed income. What is undisclosed income? The term undisclosed income is almost the same as under the block, namely money, bullion, jewelry, valuable articles or thing which have not been or which would not have been disclosed, or income reflected by an entry or expenditure, etc., which would not have been disclosed or have not been disclosed, or any claim of deduction, expenditure, or allowance which is wrongly claimed. Thus far, it's again you will find almost the same, except earlier the term expenditure, which is found to be incorrect, was not there, which would mean if I have made if I have claimed an expenditure of rupees, let's say 10 lakh, and the assessing officer finds that expenditure is not found to be correct, it will be treated as undisclosed income. Even otherwise, it will be undisclosed income because of the way in which the scheme is drafted, but this is one issue which we need to consider. How do you find out the tax liability? Now, when block was initially introduced, they wanted block to encompass everything including pending assessments. Then there was a lot of hue and cry that regular income cannot be taxed at 60%, and therefore they brought in explanation saying there will be two parallel assessments, one regular income assessments and second would be block assessment only for undisclosed income. That distinction was not carried under 153 capital A, 153 capital C, except the pending assessments will abate, rest will not abate. But then difference between block and 153 AC was, block was to be taxed at 60%, 153A, 153C income was taxed at the regular rate. So it would not really matter whether it is an income which is added under 153A or 153C. Now what is being done is, there's a definition of total income, there's a definition of undisclosed income, and total income minus some items is to be taxed at the maximum rate of 60%. This requires some discussion. Step number one, you find out your total income. What is total income? It is in 5 parts. One, whatever you disclose in your return of income pursuant to search. So it is possible, I believe that at the time of search, lot of things are found, so I file return of income disclosing income of rupees 10 crore. So 10 crore is the first component. Component number 2, total income which is already subjected to assessment. So go by my example, if I 1920 to 24-25 and broken period of April 14-24 to October 24. This is the period. By now, obviously, 1920, 21, 22 would have been assessed. What happens if in assessment there are additions which are deleted in the first appeal, revenues in second appeal. Now again additions in the second appeal, SSA loses and they are restored. Would it be regarded as a fresh item to be added again? Probably not, but this is one angle. Third, total income declared in the return of income filed which is not assessed. Therefore, let us take a situation for assessment year 23-24. I have declared income of rupees 2 crore. That 2 crore, because I have declared to the department, it is to be taken as my total income. 4, total income determined by the assessing officer on the for the year of search on the basis of books of account or entries or transactions recorded or documents maintained. Which means for the period from 1st April 24 to 20th of October 24, AO will say, I have got your books of account. In your books of account, you were to declare so much of income. I give you credit of so much of income, and I'll put it in the definition of total income. Question number 1, what if my books of accounts are not found? Question number 2, what if I'm not required to maintain books of account? Question number 3, what if my books of accounts are incomplete? How do you give effect to this? Nobody knows. And 5th, undisclosed income determined by the AO. So again, I have no problem. On the basis of search material, he may disclose. What you have marked is one item is left out. And the item that is left out is income to be returned for a year for which return of income is not due. Assessment year 24-25, return may not be due on 20th of October 24 if it's a corporate entity. Or let's say I have taken a date where it is not due. Where will you put it? If you don't put it anywhere here, AO is not going to give you a free cup of tea. He'll take it as an income assessed because he will have to assess income for the whole block. The law says he will assess the total income over here. He will give you set off of 3 incomes, which your returned income for the returns that are filed, 2, your returns which are filed and assessed, 2, returned income where you have filed but assessment has not taken place, and 3, where for the year of search, income which will be found out on the basis of the search material. But the return of income which is not due, which I have not filed, there is no provision to get set off. So the problem is, how do you capture this? Next problem. He will drop every assessment, and now he will frame assessment under a block. Let us say there are regular additions made from year to year, which I am in appeal higher up. Or even if I am not in appeal higher up, there are additions made on account of my claim not being accepted by the revenue. Now these additions will be taxed at 60%. So disallowance of foreign travel expenditure to be taxed at 60%. Disallowance of expenditure of, let's say, procuring patent, I claim as revenue, department says the capital. Because it is disallowed, tax at 60%. In other words, expenditure which is disallowed or addition which is being made which has nothing to do with block, nothing to do with the books of account, document, etc. searched, nothing to do with the search literature, everything will be taxed at the 60%. Now, please recall under the old block, this did not happen. Under the old block, this did not happen because under the old block, regular assessment was kept distinct from the block assessment. There were 2 assessments. Now they are trying to incorporate scheme of 153A, 153C by saying abated assessment will be framed again, which would mean all additions made in the abated assessment, which are required to be framed now regularly, will have to suffer tax at 60%. So this is one major problem in the block assessment. It also says if there are within the year losses, the loss would not be permitted to be set off. Now, therefore, take a situation. In year number 4, I have a loss. Year number 5, year number 5, I have a loss. Year number 6, return of income is not due. Therefore, I have not claimed it. I will not be permitted to claim the loss, but I will be told this loss will be carried forward. But sir, by not permitting me set off of regular loss, you are taxing that part at maximum margin rate of not at 60%. So again, by putting loss in a different silo as compared to income, you are again creating a situation where SSs would be required to pay tax at a much higher rate. Procedure for assessment is almost the same. You file return of income within 60 days. Belated return of income is not to be treated as return of income. Again, no extension. No notice under section 148. Assessment under 143. 2 will take place assets seized will be utilized for the purpose of assessment. We have old 158 BD now captured under new 158 BD. Same thing. The time for framing assessment is 12 months from the end of the month in which search takes place for the search SSC. For non-search SSC 158 BD, 12 months from the end of the month in which notice under section 158 BC is issued to him. Interest, there will be no interest under section 158 BF, no penalty under section 270 capital A. I was very happy. But then I read the next section, 158 BFA. Anything which is added in the computation, in the assessment, will be subject to penalty at 50% of the tax. So I filed return of income of rupees 5 crore. Ultimately, assessment is made, let's say, at rupees 8 crore. Why rupees 3 crore has nothing to do with the search. It is on account of some disallowance of routine expenditure. On 3 crore, not only I pay tax at 60%, I also expose myself to pay penalty at 50% of 60%, meaning thereby at 30%. If you file return of income, disclosing undisclosed income, pay full taxes, and agree not to file appeal on the issues returned, then to that extent, on that part, there may be no penalty, but that is provided you agree to everything. Appeal against this order will lie to Commissioner Appeal, and because the way in which the scheme is drafted, it appears that it is to be maintained by faceless, not faceless officer, local officer or jurisdictional assessing officer will have to do it. That's what the scheme appears to be. That takes me to, okay, I think we'll close in 10 minutes. Okay, fine. Withholding of refund under section 245 and interest thereon. So far, the provision was assessing officer may withhold refund, but there were two conditions attached to it. One, he can withhold refund if there are proceedings which are pending, again, in which he finds there is likelihood of demand. And second, he is of the opinion that grant of refund is likely to prejudice interest of revenue. Now, the second condition is very important. Once a refund is due to me, I must get my refund. Why should government sit on my refund? But courts have taken a view that if granting of refund to you is likely to prejudice the interest of revenue, maybe they can withhold the money. Now, proposal is the second condition will be related. Only if there are some proceedings that are pending against the SSE, the refund can be withheld. And what is the reason given? In the reasons recorded for the purpose of not granting refund, he would say as to why it is prejudicial to interest of revenue. So if he is going to say on his file, why should he separately record this particular satisfaction? But this satisfaction is very important because it is only this satisfaction which protects the interest of SSE, whereby he gets his refund in time. Section 251, so far CIT appeal had no power to set aside assessment order. He could either confirm, reduce, enhance, or annul. This was creating complication in case of base judgment assessment under section 144. So now the proposal is, in case of original assessment order being under section 144, which is base judgment assessment, commissioner would have a power to set it aside if he so thinks appropriate. Let me now go to the last major issue, VSVS in the second avatar. First of all, let's find out who are eligible. This is a scheme under which revenue says, let us settle the disputes. I wonder as to giving of such schemes repeatedly, is it not disincentive to honest taxpayers? Because if you are not honest, you raise all kinds of frivolous disputes, such a scheme comes up, and then get away without paying interest, penalty, prosecution. Be that as it may, it's a larger policy issue. I can't really go beyond this. So all those, first of all, they have picked up a date, 22nd July 24. That's a D-Day, a day prior to the date of presentation of finance bill on the floor of Parliament. That's a specified date. All those whose appeals, writ petitions, or special petitions were pending, on the specified date, 22nd July. All those in whose case matters were pending at DRP, AO had given a draft order, but the SSC's objections were not disposed of by DRP. Third, all those where DRP had disposed of the matter, but assessing officer had not passed order in compliance with DRP's direction. And fourth, all those whose revision petition, kindly mark, under section 264, not 263, 264 was pending on the specified date, have a right to or would be entitled to go under VSVS. Subject to this, the scheme is almost the same. What is the scheme? You will have to pay disputed tax, disputed interest, disputed penalty, wholly or in part, which we'll immediately see. What is disputed tax? You take it as if you have lost. So if appeal is pending, take it you have lost in appeal. If writ petition is pending, take it you have lost in writ petition, or DRP directions or revision, etc., you have lost. Whatever would be the demand is a disputed tax. If you already paid up taxes, then find out what is disputed interest and or disputed penalty. The last date by which you will have to file the declaration is yet to be notified. But let us say it is 31st of October 24. I am taking a ballpark figure. I have no knowledge of this date. I am just taking you. Therefore, don't go by 31st October. If, then the next question, unlike the old scheme, find out which is the year in which or when did the demand arise. If the demand arose before 31st January 2020, you have to pay tax plus disputed tax plus 10%. But if you pay by 31st of December, but if you pay after 31st December, probably by 31st of March, or again date to be notified, you have to pay tax plus 20%. But if the demand is raised, or demand is for the first time crystallized after 31st January 20, then you have to pay only tax, and you have to pay, if you pay by December, or you have to pay tax plus 10% if you pay beyond December. This is so far as tax is concerned. Once you pay disputed tax, interest and penalty automatically get waived. So far as interest and penalty is concerned, again depending upon if it is before January 20 or after January 20, if it is before January 20, 30% and 35%, December and beyond December. If it is after January 20, 25% and 30%. If SSC has succeeded in the first level, but revenue is in appeal, then SSC will have the benefit of paying at 50%. Because he has succeeded, now revenue is in appeal. If SSC is in appeal before CIT appeal, but he has already succeeded, and now I am using language which is important, if he has decision in his favor by tribunal or high court, therefore, though he is in appeal, he will be required to pay tax only at 50% because he has succeeded. Similarly, if he is before the tribunal, if he has got a decision in his favor by the tribunal or high court, then he has to pay tax at half the rate. Now the problem is, the language uses he has decision in his favor. Would it mean decision in his own case, or decision on the issue in the case of anyone else? Because as all of us are aware, in tax matters, there are large number of cases which are of a similar facts. On a question of law, once question of law gets adjudicated, obviously everybody will get the benefit or everybody will suffer. So suppose I have gone before CIT appeal. There's already a decision of tribunal in my group case on identical facts. Do I get the benefit? Or there's a decision of high court in my group case. Do I get benefit? This is not very clear. Probably they will come up with some clarification. But interesting part is they refer to tribunal and high court, but they don't refer to Supreme Court. What happens if there's a decision of Supreme Court in my favor? That's a vacuum. Last time, revenue was told that if there's a decision in Supreme Court, you can't call upon us to make payment. Their answer was, but then in that event, why are you litigating? But sir, I'm litigating because you made addition to begin with. If you make addition, I have to litigate. Now you make addition even if there is already existing judgment of Supreme Court in my favor. You make addition even if there is subsequent judgment of Supreme Court. Again, this will have to be clarified as to what happens in case of Supreme Court judgment. Probably they will say if there is a Supreme Court judgment in favor of SSE, nothing to be paid, because obviously then it's a law of the land. Declaration to be made by SSE within 15 days, amount of outstanding tax will be determined. SSE will have to pay within 15 days. He will have to withdraw his appeals. If he has already paid part of the amount, then balance will have to be paid. If he has paid more than what he is required to pay, balance will be refunded without interest. There are certain ineligibilities. There are a couple of issues over here. Again, this will have to be sorted out. On 22nd July 24, that is a specified date, appeal must be pending. But take a situation where I received order of CIT appeal on 15th of July 24. I have legitimate right of preferring appeal to tribunal for at least 2 months. I have not preferred appeal. Not that I did not want to prefer appeal, I have not preferred appeal because I have not run out of time. In the group case where I received order, let's on 15th of April 24, I have preferred appeal. Therefore, that appeal is pending. This appeal is not pending. Would in this situation, SSE have a right to file the VSVS declaration? As the scheme today stands, answer is no. They will come up with some clarification. But I believe they will come up with some clarification only in relation to appeal, because so far as REIT is concerned, you can file at any point of time. So otherwise what SSEs might do would be, order was passed 5 years back, 7 years back, I can just go and file writ petition challenging it. High Court may not ultimately entertain, but today I don't need to show that I am likely to succeed. I only need to show pendency. So therefore, probably they will have to say, whenever period of limitation has not run away, on 22nd July, the SSEs may be entitled to file declaration, provided they subsequently file appeal. But only time will tell us. I would not really know whether this is going to happen or not. That takes me to 4 or 5 not very significant amendment, but I think now that we have spent so much of time, let me take 3-4 minutes more. No change in the rates of taxes. Slab has, for the old scheme, remained same. For the new scheme, minimum slab has gone from 5 lakh to 7 lakh, giving benefit of, as everybody is knowing, total benefit on account of that, plus standard deduction is between 15 to 20,000 rupees. Income from letting of residential houses will now necessarily be income from business, not income, sorry, it will be necessarily only from income from house property, no business income. 92 CA, okay, that is, let me not spend time. Today, if reference is made to transfer pricing officer, he has a right to look into issues other than on which reference is made for international transaction, not for specified domestic transaction. That anomaly is sought to be cleared. There is a reduction in the rates of TDS on various sections. But most of the sections, barring section 194H, which is commission or brokerage, where the rate has gone down from 5% to 2%, are really not material. But other provisions have remained the same. Like 194I, TDS on rent remains 10%. 194J, which concerns all of us, professional services, continues to be 10%. 194T is being introduced. Now, when a firm pays to a partner any remuneration or interest in excess of rupees 20,000, there will be TDS at 10%. So, one more area of filing of returns, filing of annual returns, TDS, so on and so forth. But now 10% is required to be deducted. I think the rest are minor issues. I think we already have overshot. With this, let me thank you all for giving me a patient hearing. As I was repeatedly told, this is more than 25 years I have been speaking. I'm not sure whether I will be speaking next year or not, but so if I speak, I'll be very happy. Otherwise, all the best. Thank you very much.
Good evening, friends. It's my great privilege to extend a vote of thanks on behalf of Ahmedabad branch of WRC of ICI and Chartered Accountant Association Ahmedabad. I would like to express my profound gratitude to our senior advocate, Sri Saurabh Soparkar ji. Also thanks to all active participants. One more announcement that ticket on sale or available on outside India for talent evening cultural program. Who want to take the participant, please collect the ticket. Each pass as a assure gift. Once again, sir, thank you very much, and thanks to all active participants. Thank you very much, sir.